My name is David Ziegelheim, and my question is, why didn't the government just say you couldn't trade credit default swaps anymore? It would have been very simple. You can't buy them, you can't sell them, and they won't count against your reserve requirements. Let's look at what the situation was. They already couldn't trade them. Because the market had collapsed, and as a result they had to mark them to zero because of the market rules, that is the primary factor that made the banks insolvent. They had $60 trillion of credit default derivatives against about $10 trillion of debt, of which maybe $5 trillion or less had been lost. Point two, the banks were already profitable. Their core businesses, other than these derivatives, was profitable. AIG was a profitable insurance company. The reason you had Merrill giving bonuses is because the other parts of the business were profitable. Just needed to deal with these credit default swaps. Point three, the credit default swaps net each other out. That is, if I'm Bank B, I typically have a swap with Bank A and a swap with Bank C that net each other out. And as an aggregate, the way that swaps were counted, both halves, the buyer and the seller, were counted in that 60 trillion total. In the end, they net out, but even for individual institutions, on a whole, they net out. Now, what if you needed the redeemable value of your credit default swap? You were using it as insurance, and without that additional money, you were insolvent. The government could have loaned, since we're going to work out this market, the government could have loaned, say, 50% of the value, redeemable value, to whoever needed it, and it would have then, any difference in thing would work out as the overall program. Well, what would have happened? I've said work out a few times. The government could have simply said, we'll work this out over 5 or 10 years. We'll figure out who owes who, work out what the net amounts, and just settle the net amounts. And if it was a loss, 5 billion, 10 billion, 100 billion, it could have been worked out over 5, 10, or 15 years. It would have still been a huge bite, but a bite which these large financial institutions could have absorbed. It would have reduced their shareholder equity, but their shareholder equity has been wiped out anyway. So that really isn't a significant difference. They took the loss, they should take the risk. However, it wouldn't have created the damage to the financial system. Now, let's look at an analogy. When your car hits a bump, this wheel goes up, and if it didn't have a shock absorber, it would just bang and the car would bounce uncontrollably. The shock absorber, called a damper in the UK, absorbs energy as the wheel's coming out and controls its release as it comes down. The result is you're able to continue smoothly driving your car. The same thing was needed here. This program would have acted as a damper on the financial system. Thank you for listening to me. My name is David Ziegelheim.